For the last few weeks, we've been looking at the births, marriages, and deaths, the hatch, match, and dispatch of business. I hope you found the comments useful and perhaps thought provoking. We now move on, but in similar vein, last week we spoke about you and your business going separate ways. This week seemed appropriate to talk about pensions. Now, this is a complex area, so we'll only be able to scratch the surface. So I want to concentrate this week on the difference you see between paying into a pension fund yourself or alternatively getting your employer, which may be your own company, to pay the contributions. If you pay the money yourself into a pension, you have to fund the premium out of money on which you've already suffered income tax and national insurance, so there's immediate cost. You get basic rate tax relief. Effectively, you pay the premiums net of basic rate tax. And if you're a higher rate taxpayer, then you'll get higher rate tax relief, which you claim in your self-assessment tax return. What happens if you get your employer, which may be your own company, to pay? The company pays the contribution gross, but should get tax relief as an allowable expense through the P&L. Even though it is going into your pension, you pay no tax or national insurance on that amount. So, quite an advantage. But before we go any further, I just want to mention some limits imposed by the legislation. First, personal contributions are limited to £3,600 gross or your earnings, whichever is the higher. Secondly, employer contributions are only limited by being required to be part of a commercially justifiable remuneration package. Third, all contributions are limited to a maximum of £40,000 per annum. However, if you don't make use of your allowance in 1 year, it can be carried forward for up to 3 years. Lastly, there is a lifetime cap, broadly £1 million, that you can have in your fund. Let's look at a couple of scenarios and compare the outcomes. In each case, we're using a company budget of £10,000, whether this be paid as a salary or as an employer pension contribution. Scenario one, we're going to assume that you're on a salary of £60,000 and then get dividends of £20,000. If the £10,000 is funding a personal contribution, you need to extract the funds from the company. Part of the £10,000 therefore goes to fund the employer's national insurance of 13.8%. You then suffer tax at 40% and also national insurance, although it's at the reduced rate of just 2%. After employer's national insurance, you're only left with £8,787, and after tax and national insurance that you suffer, the amount left to pay into your pension is only £5,097. The government then tops this up with the equivalent of the basic rate of tax, so you now have £6,371 in your pension. You personally will get higher rate tax relief on the premium, and out of this, if you choose to, you could make a further payment into your fund. Let's consider a basic rate taxpayer, typically low salary and dividend profit extraction. In this case, a salary of £12,000 and then a dividend of £20,000. The calculations are similar to scenario one, the higher rate taxpayer. You still have to fund the employer's national insurance, but here you only pay tax at 20%. But the rate of national insurance is higher because you're no longer at the reduced rate. The end result is that you make a net payment to your pension of £5,976, and the government tops this up with a further £1,494. So your pension fund now has £7,470. But this time, because you're a basic rate taxpayer, there's no higher rate tax relief. This is where it gets exciting. Let's now revisit scenario one, a higher rate taxpayer, and see what happens when a £10,000 contribution paid by the company is paid directly to the pension company. The company pays out £10,000 without deduction of tax. You as a taxpayer suffer no tax or national insurance, even though she's going into your pension. The pension now has £10,000. There's no top-up from the government. I've not mentioned tax relief on the additional salary or pension premiums, partly because of time is limited, but also because the same amounts are tax deductible in the business, whether it's paid as salary or as pension. So it seems pretty clear to me that an employer contribution is to be preferred. Please remember that there are a lot of complex rules in this area that we have largely ignored. So if you want to find out more about what you should be doing in your particular circumstances, please get in touch. I'm Alan Long from Long Partnership, making life less taxing.